Hello and welcome to Engage with your local government pension scheme, or LGPS for short. I'm Finola Middleton. I'm the Employer Pension Fund representative from the Employer Relations team here at the West Yorkshire Pension Fund. And we're here to support employers and members regarding the local government pension scheme. In today's session, I'll be highlighting the key benefits of the scheme, just to emphasise that there are so many more benefits to the scheme than just building up a pension for your retirement. Your pension provides benefits that are not just for you, but for your loved ones as well. I'll explain how the pension scheme works, how it's calculated, how your benefit builds up over time, and to illustrate how this can help you plan for your retirement in the future. I'll also cover ways you can increase your pension benefits at retirement as well. I'd like to introduce you to our My Pension system, which is our online portal to view your pension details. There is an estimate function on there that we love to promote, which is very beneficial to support you as a member. Lastly, I'll cover the various resources that are available to help your understanding of the pension scheme better, and the resources available to answer any questions you may have throughout your pension journey. If you're still unsure of anything, don't worry, we're here to help, and I'll cover the various ways in which you can contact us here at the West Yorkshire Pension Fund as your pension administrators. Just to explain something about ourselves and our operations. We administer the local government pension scheme for the West Yorkshire Pension Scheme and a number of other funds in a shared service partnership model. In 2015, we first entered into partnership with Lincolnshire County Council with the aim of improving efficiency and best value. We have since expanded and we now have a shared service that includes the London Borough of Hounslow and the London Borough of Barnet. On top of our local government clients, we administer a number of firefighters' pension schemes, and this brings our total shared administration service partners to 27. Overall, we administer for over 850 employers with over 400,000 members of the scheme, and we do this with 112 staff dedicated to pensions administration and a further 19 investment staff, and we have offices in Bradford and Lincoln. On this slide, we have a summary of the key benefits of the scheme, and they are a secure retirement pension, you gain tax relief, you have access to a tax-free lump sum, there's ill health cover, life cover, and a survivor's pension. And through the next few slides, we're going to look at them individually in detail. So let's look at retirement first of all. Providing you've been a member of the scheme for 2 years or more, you can access your benefits from age 55 to 75. You currently have to leave the pension scheme before age 75. If you decide to take early retirement, which is at any point before your state pension age, your pension benefits will be reduced. Or if you claim your pension at any point after your state pension age, it's classed as an age retirement and no reductions are applied. It is expected that the minimum age to access your benefits is going to change to age 57 from April 2028. There are other types of retirement in the scheme, which are only allowable at your employer's discretion. Flexible retirement is from age 55 onwards, and that's where you can receive immediate payment of all or some of your benefits and continue working. And this is either by reducing your hours or reducing your grade, subject to your employer's policy. Redundancy or business efficiency retirements is where if you're over 55 and your employer makes you retire due to redundancy or business efficiency, then you can access your pension benefits straight away without a reduction. And you can also have ill health retirement from any age, subject to conditions and supporting medical evidence. In terms of being a secure pension, it's a guaranteed pension backed by law, so it's in the local government scheme regulations of how it's calculated and guaranteed. It doesn't depend on investment return like some of the private pensions, so there's no worry of how well the stock markets and investments are performing, and I'm sure you're aware of the turbulences the market can have. So the assurance is that the pension you're entitled to is what will be paid to you at retirement, and it's inflation proofed. This means it'll keep its value in line with the cost of living. And as you're aware, the current cost of living crisis, having an inflation-proof pension is a valuable benefit. And this means your pension account was uplifted in the year 2023 to 2024 by 10.1%. And lastly, it's payable for life. As a member of the scheme, you get tax relief. So that means you receive tax relief on your contributions. Your contributions are taken at source by your payroll department. You don't need to worry about managing your contributions. And the key point here is the benefit that you receive of the tax relief is a key benefit of your contributions. And I'll show you a practical example of this later on in the presentation. So at retirement, you have the option to access a tax-free cash lump sum as part of your retirement benefits. All members have the option to increase their tax-free lump sum, and what this means is that you can swap some of your pension for lump sum. And as you can see, for every £1 of pension you convert, you get £12 of lump sum tax-free in return. The maximum lump sum is set by the HMRC, and that can only be up to 25% of the capital value of your accrued rights, and that will apply overall to all your pensions at retirement. If you're no longer fit enough or able enough to carry on working, your benefits can be released on health grounds. Ill health retirement is only allowable at your employer's consent and is subject to certain conditions. And what this means is that if you qualify, you potentially could be eligible for immediate payment of your pension. There are 3 tiers awardable, so depending upon your ability to undertake gainful employment and carry out the duties of your current role, that will determine which tier you're awarded, and that's subject to an opinion from an independent registered medical practitioner. Again, this is inflation proofed, so it keeps its value in line with the cost of living. But ultimately, it's an employer's discretion, and where there are disagreements, there is an appeals process. The law allows the opportunity to challenge the decision via the internal disputes resolution procedure. The scheme has life cover. In the unfortunate event of your death, a lump sum is payable at 3 times your annual pensionable pay, and this is payable to a loved one of your choice. So you can nominate who you would like this to be payable to, and you can elect multiple nominees as well. You can nominate anyone to receive this benefit. This could be a spouse, partner, children, or even a charity. You can nominate for the lump sum to be split equally or as different percentages as you may wish. You can update your death grant nomination online via the My Pension system. So if your circumstances change, you can update your nomination easily on our portal. The scheme provides a survivor's pension, so there's peace of mind to know that your family will have financial security. There is a pension payable for your spouse, civil partner, or eligible cohabiting partner, and potentially eligible children. For eligible children, there are certain conditions they must meet to be entitled to the payment of a pension. They normally need to be under 18 and in full-time education. Now we're going to look at who can join the scheme. You can join the scheme if you have a contract of 3 months or more, if you're under the age of 75, and you're not eligible to join public sector pension schemes, such as the teachers, universities, or civil service. Once you're contractually enrolled, a pension record is created for each role that you hold, and your pension record is linked to your employment record. If you only have one role, you'll only have one pension record. If you have more than one role, then you're going to have a pension record for each role. So for example, if you're a midday supervisor and a breakfast club assistant, you'll have a pension record for each role. Just bear this in mind in case you're wondering why you have more than one statement and pension record. A transfer usually buys more if it's fully completed within a year of you joining the scheme. And if you decide not to look into a transfer when you first join the scheme, your employer or former pension scheme might not allow it later on. Your automatic right to transfer expires after your first year of employment. You can still have one after that time, but it's only at your employer's discretion. A transfer can be accepted from another registered pension scheme, provided it's approved by the HMRC or a European pensions institution. But a transfer cannot be accepted in respect of a pension credit rights awarded by a pension sharing order. Let's have a look at the transfer process. The transfer request forms are available on our website for you to ask for a transfer quote. If you fill in Part A and send it to the previous pension provider, when they reply, you send that information to us. We run that through our systems and reply to you with how much it's worth in our scheme. And you let us know if you want to go ahead, then we'll request the payment if it's a yes. Your previous pension scheme pays the transfer value to us, and we update your pension scheme record and tell you what the transfer has bought you in our scheme. It can be a lengthy process, so always start it sooner rather than later if you haven't already. Let's have a look at the contributions you pay. You will contribute into the pension scheme to cover the cost of providing you with a pension, and that's based on your actual pensionable pay. So depending upon the pay band you fall into, as per the slide, this will determine the contribution rate payable by you into your pension. These bands change annually to move in line with inflation. In some cases, you may change bandings even though you've not had a change in pay. So your actual pensionable pay includes non-contractual overtime and additional hours for part-time workers. Your employer contributes to the pension scheme as well, and their contributions cover the extra amounts needed to fund members' benefits. The employer's contribution rates are set by the actuary following a triennial valuation. Their contribution rate has been set for the following 3 years, and the year 2022 was a valuation year, so the employer's rate has been set from April 2023 to March 2026, and your contributions attract tax relief. So what does it actually cost to be in the pension scheme? So if we look at someone not paying into the pension as a comparison, so in this example, the salary is £24,500, equating to just over £2,000 a month gross salary. They pay tax of £199 and national insurance contributions of £119, which gives a net pay of £1,724. So if we look at someone paying into the pension scheme, again, they're earning just over £2,000 a month in salary. They're now paying £118 of contributions into the pension scheme, which is based upon the pay band rates table we've just looked at. The member is paying 5.8%. What you will see is the tax is reduced. So this means you're receiving tax relief on your contributions to save for a pension. The national insurance is the same, and the net pay is now £1,630. And this works out per month at a net cost of £94, which in comparison to a non-member means you're building up a pension benefit for retirement at a tax-efficient rate. You're protecting your future by saving for retirement, so you can live the life you wish and afford the things you'd like when you reach retirement age. So your contributions cover the cost of providing you your pension, and as I've said earlier, the employer also contributes to cover the cost of providing you your pension. On average, the employer contribution rate is around 13%, if not higher. The scheme is currently a CARE scheme, which is Career Average Revalued Earnings Scheme. This means the pension builds up as an average of the pay that you receive throughout your career. The CARE scheme is a defined benefit scheme, which means benefits are calculated using a formula of the member's pay and the accrual rate. For each year you work, we look at how much pensionable earnings you have received and take that figure and divide it by 49, which is the accrual rate of the main scheme. The accrual rate is simply the rate at which your pension builds up. If you're in the 50-50 section of the CARE scheme, which I'll explain more about as we go through the slides, the accrual rate would be a 1/98th and not a 49th. And this would mean that your pension would build up to half the amount of pension that you would have if you were in the main section of the scheme. Each year, the annual pension you have accrued is revalued in line with inflation, and this is based on the Consumer Prices Index, which is commonly known as CPI. So, if I can explain how the pension is calculated in a CARE scheme and how it builds up over time. The CARE scheme works by taking a proportion of your cumulative pensionable pay and provides the amount of annual pension which builds up over time. And every year, the annual pension accrued by a member is revalued in line with inflation. So that's the Consumer Prices Index I just mentioned. If we look at this example on the bar chart, the 1/49th or the 1/98th of the pensionable pay received in year 1 becomes the opening balance. In year 2, we bring that amount into the pension account, as well as add in the pension that would be built up in year 2, and then inflation is added to it. So each year you can see the pension build up for your retirement, and this illustrates the principle that each year inflation can increase your benefits as well. Here we have another example showing how a pension builds up over a 3-year period. The journey starts with the first year's 49th accrual at the 31st of March, and then inflation proofing is added, and the pension builds up cumulatively as we go through the years. As we look at the second year, we have the opening balance, which is last year's pension accrued with inflation, then a 49th of the pay and inflation proofing at 3.1% is added. So you'll see here, after 3 years, this person would have a pension account of £1,750.70 as an annual income. If they were in the 50-50 scheme, they would have accrued half of that, and they would have £875.35 as an annual income. This shows how quickly your pension builds up over a period of time. If I can tell you a bit more about the 50-50 scheme, which I've mentioned a few times up to now. It's a good way to pay half of your standard pension contributions for a while and stay in the scheme. It's a good idea if you have a situation of affordability or cost constraints. The pension builds up at half the amount of pension compared to the main section. So the pension builds up at a rate of 1/98th accrual. You still have the key benefits of full ill health cover and full life cover, so you can be confident that your loved ones will be looked after in the 50-50 section of the scheme, as well as the main scheme. You only pay half the contributions, and you can move back to the main section of the scheme at any time. And you will automatically be brought back into the main section of the scheme following an auto-enrolment anniversary or following nil pay as a result of sickness, injury or child-related leave. So here we have another example in this slide to compare the differences between the main scheme and the 50-50 scheme and the effect on a member's pension build-up over time. If we take the example of someone earning £21,000 pensionable pay, and we assume the cost of living increases at 2%, a pay increase of 2%, and a term in the scheme of 40 years. So in the graph, you can see how the person in the 50/50 scheme builds up half the amount in the light shading as compared to the main scheme, the member in the red shading. The red main scheme builds up to almost £40,000, whereas in the 50/50 section in white, they build up to half that in pension, but they have paid half the contributions to get just under £20,000. Again, the slide shows the pension build-up keep pace with inflation, and the example here is a pint of milk should be affordable at the start of the career and at the end of your career. It's worth mentioning that the Local Government Association have an LGPS scheme modeller which can be found on the link on the screen. And through this, you're able to make projections and see how joining the 50/50 section of the scheme will impact you and your pension build-up. Prior to the 1st of April 2014, the pension scheme operated on a final salary basis. And if you remember then, you'll have built up final salary benefits to this point. And that link is still maintained for you in the scheme. The final salary scheme is based on your final salary and your service. We use your actual service and always your full-time equivalent pay going back 365 days from your date of leaving, even if you work part-time. We don't include any non-contractual overtime, and it's more than likely it'll be close to the scale point that you're on for your salary. To calculate final salary benefits, we use the pensionable service for the years and days you accrue from the point that you join until certain dates. It's prorated to reflect anybody that worked part-time. So if you worked half-time, 18.5 hours, instead of 37 hours over a 2-year period, you would have built up 1 year's service for 2 years of employment. Also included in the calculation is the accrual rate. The accrual rate changed on the 1st of April 2008, so there are 2 rates applicable. The first rate was an 80th, and then on the 1st of April 2008 it changed to a 60th. And these are the differences used in the calculation of the pension for these periods. If you've left the scheme and returned within 5 years, you can choose to link your previous benefits and retain the final salary calculation. But if the break is more than 5 years, you only have the option to keep them separate or transfer it in as care pension only. So just to give you an example of how we calculate final salary benefits, this is if you're in the pension scheme before the 1st of April 2014. We take the pensionable service that you have accrued. In this example, the person joined on the 1st of April 1998, and they have 2 periods of membership. So right up until the 31st of March 2008, the accrual rate was an 80th, and they have 10 years worth of pensionable service for this period. So in that calculation, it's 10 times the final salary of £20,000, and then we divide that by 80. So in this example, we've calculated an annual pension of £2,500, and attached to that is an automatic tax-free lump sum of 3/80ths of the final salary and service. So for this example, there is a tax-free lump sum of £7,500. Then the accrual rate changed on the 1st of April 2008, right up until the 31st of March 2014, when final salary stopped being used. The maximum anybody could have if they worked full-time would be 6 years. So we would use 6 years times 20,000 and divide that by 60, which is the accrual rate. So that's given them a pension for that period of £2,000. However, this period of membership accrual doesn't have an automatic lump sum, but they can reduce their pension to increase their lump sum. And that's how we calculate final salary benefits, and they're explained in more detail on your pension statement. The scheme offers pay protection in the form of the best of the last 3 years, or a 10-year protection if there's been a material reduction in pay. Final pay is always calculated on the full-time equivalent rate of pay. If the hourly rate of pay doesn't reduce, it's not a reduction in pay. A reduction in hours does not constitute a reduction in pay, whether you work full-time or not. For the best of the last 3 years, we check the final pay going back 365 days from your date of leaving over 3 years. If a previous year's pay is higher, that's what we use to calculate your benefits. The 10-year protection applies if there's been a material reduction in pay, which is confirmed by your employer. The 10-year protection applies due to an enforced change, such as a reorganisation, job evaluation or restructuring. The protection is on the final salary benefits only. The protection only applies with the employer that confirmed the reduction. Therefore, if you move to another employer, the protection does not apply. The pay protection will expire 10 years after the date the drop in pay occurred. We get informed by your employer, normally at the point of the reduction taking place or at your date of leaving. And what we do is we put a marker on your pension record, so we're able to action at the appropriate point in time, and you would normally receive a letter informing you of this. You as a member don't need to worry about this. It's all automatically done between us here at the Pension Administration and the employer. This is what your pension statement looks like. This shows how your pension has built up and the cost of living adjustment, and it confirms your total annual pension at the point of the statement. It's usually at the 31st of March. However, the most useful part of the statement is the projections on page 2. If you're under age 55, then you'll get the full range of projections at ages 55, 60, 65 and your state pension age. However, if you're older than these points in time, the projections will be adjusted accordingly. Each retirement point shows standard benefits for your annual pension and lump sum. These figures also include any reductions that apply to your pension for drawing it early at the respective ages. And then also the maximum lump sum you could receive by giving up some of the pension. This provides you with key information to assess and plan for your future retirement. If, after looking at your annual pension statement, you feel the scheme is not giving you the pension amount you would like for your future, then you'll see here on the next slide there's always ways to top up your pension for your needs and objectives. So in terms of paying extra, the first of these are AVCs, which stands for Additional Voluntary Contributions. And this is a facility offered to allow you to pay extra contributions towards your pension. These are invested separately to your main scheme benefits in your chosen AVC investment plan. We work in partnership with AVC providers, such as Prudential, to provide these options. Please refer to the Paying Extra section of our website to find out which AVC provider your pension fund partners with. If you're a taxpayer, you'll receive tax relief on any additional contributions that you make, and you may pay up to 100% of your pensionable salary into an AVC arrangement. Your AVC fund can be used to buy additional pension. This can be additional income through an annuity, or it may be taken as tax-free cash at retirement. If you take it as cash, you don't have to reduce your main scheme pension to obtain the maximum tax-free cash available. Of course, all of these options are subject to the HMRC limits, and we'll provide you with all the options available to you, including your AVC, as part of your retirement pack. If you'd like to set up an AVC, you'll need to contact the relevant AVC provider directly, as per the instructions on the website under the correct fund when you want to join. So if we can look at APCs, additional pension contributions, these buy you additional pension. You gain tax relief on the contributions, and you can pay extra contributions each month or via a lump sum. You can buy extra pension up to the maximum of £7,579 in the tax year 23-24. This limit is index linked and rises by CPI each year. One thing to note is that you can't buy extra pension via APCs if you're a member of the 50/50 scheme. If you are interested, you can get a quote. There's a link on our website to an APC calculator from the Local Government Association, and that will show you the cost of buying additional pension. To find out more details about either of these options, please head over to our website and take a look. My Pension is our online portal which gives you the tools to access the information about your own pension, and it puts you in the driving seat to take ownership of your pension account. So from the online portal, you can view your membership details, update your contact details, update your death grant nominations, and view your documents, such as your annual pension statement, and this will help you to manage your pension account. As well as allowing you access to the key information in relation to your pension account, My Pension helps you ensure that the data we hold in respect of you is accurate and up to date. The portal is easy to navigate using the main 4 tabs along the top once you've logged in. So there's membership details, personal details, change my account, and view my documents. And now you can also run your own estimates. The web address listed on the slide is where you can register for My Pension if you haven't already done so. So if you've not already signed up, you can do this very quickly and easily as per the steps here. You simply click on My Pension link to register your details on our website. An activation key will be emailed to you. Once you've activated your registration, you'll have full access to the facilities I mentioned earlier. And if you're struggling, we have a video available to help you on our website and guide you through the steps to complete the registration. We think online's a good idea because it keeps you up to date. There's no need to store your documents at home, so that has to be good for the environment. It's a one-stop shop for you. It's designed to be clear and accessible, and it'll support you in your pension journey. Then when you are signed into My Pension, the online portal is designed to give you a snapshot of your pension. You can see there's a side menu of options which will allow you to view My Folder documents, such as your annual pension statement. You can also view payslips and P60s if you're a pensioner, and double check the information we hold for you is correct. The online calculator will allow you to run your own estimates. To run an estimate for your pension, it's quite straightforward. You simply input your date of retirement, which has to be between age 55 and age 75, and press Submit. Most recent pay information we hold for you will be pre-populated. If you're happy with this, then press Submit. If you want to provide different pay information, you can enter it here, but please make sure you include the pounds and pence. And make sure you understand what pay you should be using. There's more information about this in the guides on our website. Once submitted, My Pension will calculate your retirement estimate. And once the calculation finishes, you'll be able to click on Show Documents, and your figures will be saved in your My Pension account. And you'll be able to see them and download them again in the future. If the information you have submitted is correct, then the output will also be correct. There's no limit to the number of estimates you can run via this facility. I would also like to make you aware of some additional resources that are available to you and can help you in your pension journey. Firstly, there's our website, the West Yorkshire Pension Fund website, which is our own dedicated scheme channel with lots of specific detailed information, and it's where you can register for My Pension. The Retirement Living Standards website is there to help you plan for the future, and it's provided by the Pension and Lifetime Savings Association. It pitches 3 levels of retirement models: a minimum, moderate and comfortable, based on a basket of goods and services from food and drink to holidays for you to plan against. The Money Helper website is another site which is useful, and it's provided by the Money and Pensions Service, which in itself is a body sponsored by the DWP. And this is a wider range of financial information, and it's home to the PensionWise service, which is for advice and guidance, and you can book personal consultations with them. And finally, the LGPS member website. It's provided by the Local Government Association, and that's where the national scheme resources are, including the calculators that I mentioned earlier, and it's home to the pension modeler. If you are considering retiring soon, then you might be interested in joining one of our pre-retirement planning sessions, which is run by our partners Affinity Connect. They will help you keep your retirement plans on track and get you to start to plan early. These courses run all year and are online, so please have a look on our website for the dates, and you can book on these courses at a time that's convenient to you. And in terms of support, we can provide for you if you have any specific scenarios that you're struggling with, or you still require some assistance, then please do get in touch with our customer services team at the Customer Contact Centre, and they'll be able to assist you. Their details are here on the slide. You can email or call us, and don't forget, there's a wealth of information on our website, and of course that's where you register for My Pension. We have some actions for you. We'd like you to register for My Pension if you haven't already. When you're in your account, remember to update your nominations, and of course check your details are as they should be. Review your annual pension statement and calculate your own estimates. And finally, the disclaimer. This presentation has been issued to you by the West Yorkshire Pension Fund. This guidance has been prepared on the Fund's current understanding of the scheme regulations, therefore should not be treated as complete and authoritative statement of the law. Users may wish or will need to take their own legal advice on the interpretation of any particular regulations. No responsibility whatsoever will be assumed by the Fund for any liability, financial or otherwise, incurred by stakeholders relying on this statement. The Fund does not accept any responsibility or reliance on the contained or referred to in this guidance.